Let's be honest, investing can feel complicated. But what if I told you there's a simple, low-cost way to build your own portfolio? No expensive advisors, no confusing jargon. Today, we're handing you the blueprint to take charge of your financial future. Let's jump right in. Does this sound familiar? You're trying to do the right thing and grow your money, but everywhere you look, there's some guru pushing complex strategies or hot tips. And of course, they all come with some pretty hefty fees. It's frustrating, right? It can make you feel like you're not smart enough to do it yourself.
Let's just put the two approaches side by side. On one hand, you have the guru way. It's often a tangled mess of complexity and high fees that eat into your returns. But on the other hand, there's the DIY way. We're talking about a simple blueprint, keeping costs super low, and, the most important part, you are in the driver's seat.
So, to really take control, we need to build a solid foundation. Instead of just, randomly picking a few stocks or funds, we're going to build a proper portfolio. And it all rests on 4 essential pillars. Let's see what they are.
Okay, this is a really crucial point. A real portfolio isn't just a list of stocks you own. A much better way to think about it is like a well-balanced team. Each player, each asset, has a very specific job. They all work together to help you reach your goals, manage risk, and make sure you have money available when you need it.
Here's how that team is structured. First up, you've got your growth pillar. This is your star striker, usually stocks or equity, doing the heavy lifting to grow your wealth. Then you have stability and income, things which are like your solid defenders, providing safety. Emergency pillar, that's your goalkeeper, cash ready for any unexpected surprises. And finally, diversifiers like gold, which are your all-rounders, protecting the whole team when the market gets shaky.
All right. With that foundation in place, let's get to the main event, the blueprint itself. This is the actual practical plan you can use. It's designed to be a balanced starting point for most retail investors.
And here it is. Take a look. Notice that exactly half of it, 50%, is in equity. We've split that between 35% in big, stable companies, that's your large cap, and 15% in smaller companies with more growth potential. Next, 25% goes into debt for that stability we talked about. A really important 15% is kept as cash for emergencies and maybe some opportunities. And finally, 10% is split between diversifiers like gold and real estate. Honestly, for most people starting out, this is a fantastic, well-rounded portfolio.
Okay, great, you might be thinking. But how do I actually buy these things? Well, it's simpler than you think. For your large cap exposure, a basic Nifty 50 index fund is perfect. For gold, sovereign gold bonds are a fantastic, tax-efficient choice. And for real estate, you don't have to buy a flat. You can just invest in listed REITs, which are basically a basket of rent-earning properties. See? Every piece of our blueprint has a simple, low-cost tool you can use.
So you've got the plan, you know the tools. The big question is, where do you start? How do you go from watching this to actually doing it? Let's break it down into 3 simple steps you can literally take today.
Step 1, and please listen to this carefully. Build your emergency fund first. This is non-negotiable. Before a single rupee goes into the market, make sure you have 3 to 6 months of your living expenses sitting safely in a liquid fund or just a savings account. Step 2, get your tools ready. That means opening a demat account and an account on a mutual fund platform. And step 3, this is the magic sauce, automate it. Set up SIPs so you're investing consistently every single month without even thinking about it. And as you get going, just keep these 4 golden rules in your head. 1, don't chase whatever did well last year. That's a losing game. 2, and I'm going to say it again, your emergency fund is sacred. It never touches the stock market. 3, just say no to high-fee products. They're a guaranteed way to slow you down. And 4, stick with your SIPs. That simple discipline is what really builds incredible wealth over time. And why are we so obsessed with fees? Just look at this. A tiny 1% difference in fees. It sounds like nothing, right? But over 20 years, that small leak can sink the ship. It can literally rob you of lakhs or even crores of your final wealth. This is exactly why a low-cost, do-it-yourself approach isn't just about saving a little money, it's about dramatically improving your chances of success. So, there you have it. We've laid out the pillars, we've given you the blueprint, and we've walked through the first steps. The complex has been made simple, the path is clear, the tools are right there for you, and the control is finally back where it belongs, with you. The only question left is, are you ready to build it?